welcome everybody. My name is Jeff from Cortex, not Channing Tatum, but you know, I'm sure people will mistake me for him as we go. And this workshop is Tokenomics and Digital Asset Landscape. And you know, we're going to spend the next about 90 minutes going through these 6 items, and it will be fast. It will be very granular. We wanted this to be super informative and granular, but this is recorded, so you can go back and listen and watch. The other thing I want to call out is this is a moving target. If you're here on this call, you understand that, you know, this is all always changing. Okay, the regulatory landscape around digital assets is different today than it was yesterday, and it's going to be different tomorrow. We were just on a call with the Cortex team talking about some things that we have coming up, and the idea that we want to target certain regions of the world with some of the things that we're building because there is, excuse the pun, clarity. You know, we can build with a certain level of confidence that the rules aren't going to change so much in those places, so we could build compliant products to fit certain regions. And that doesn't exist everywhere. You know, in the US, we're getting close. In Europe, we're pretty close. In places like Africa and India, we don't know. Latin America, probably closer than the US in a lot of ways. So these are important things to take into consideration. So let me go ahead and give you a little bit of a introduction to what Cortex is. We are a service and product organization. We offer services from a global network of incredibly expert people in just about every area you can think of. And we are also a product studio that a number of our products in development will be hitting in the next couple of months. Our focus, though, is all service-oriented. Even our products are adoption and service-oriented to try to grow this pie. And this is the team that's going to be sharing with you today. I already introduced myself. We also have Ella here, who's going to share with you a lot of interesting information about compliance globally. And then David Carter, who brings years, dare I say, decades of experience, really doing just about everything that you can think of, not only in this industry, but when I first met David, he headed up the digital asset arm of SADA, which is the biggest reseller of Google Cloud in the world. So, I mean, he's been on lots of different sides, and he'll bring a very interesting and very relevant and present lens onto this topic of tokenomics and digital assets. So I'm going to kick it off. And for some of the folks, I'm looking at the people in the room, this will be review. It's nothing new. But at the same time, it's always good to go back and review some of these definitions. I say that because in an increasingly regulated world with a lot of legal practices being applied to this industry as we grow adoption, so this is all good stuff, knowing the formal definition of things and remembering the nuances of formal definition is power, because a single word could be the difference between compliant and not. So here is the NCUA formal definition of a digital asset. Okay, first crazy slide. And the idea is not for you to hear and read these slides. It is to have this as a resource as we go. And as you review this video, to be able to access this probably in a bigger blown up version of this. But before we, talk about this specific slide, it's important to talk about process. Our process is about being really thorough in questioning everything. Okay. Those of you who know me, you know that I'm big on asking good, hard questions. Asking about, every audience, what do we need? What do we need them to know? Who are we talking to? What's the messaging? What's the language we use for them? That helps us forecast. That helps them be able to share feedback with us with where they are, regardless of whatever we currently think is happening in the moment. Remember that knowing your audience and being aware of the regulatory landscape in this industry is integral. Every day, whether you're a builder, an investor, an advisor, legal counsel, financier, whatever, you need to remind yourselves of these things every day. And so we always design everything we do, including this presentation, with tremendous patience, depth, a little bit of creativity, and extrapolation. We could take what's available to us today and we can make plans, but if we don't extrapolate and forecast into the future about what might be, we're creating more work for ourselves later. So one of the things I also want to encourage everybody here who's interested in this topic is look at the history of money. Look at the history and the evolution of exchange, of value accrual and transfer. Because that's really what we're talking about here. We're talking about the transfer of value. What is value? I'll give you 2 chickens for a donkey because I have a lot of chickens and I need a donkey. Trading and the emotional, psychological component of trading. Okay. The people that are really good traders, they're not on Twitter and they are not emotional. And that's their advantage. That's their edge. But being on something like Twitter or any social media does give a trader insight into sentiment. And sentiment impacts value. Okay. The other thing that impacts value is human need. My feeling about why stablecoins are becoming so massive, aside from they are comfortable and familiar and so on, is they translate directly into fulfilling the necessity of users. I can't go buy groceries with Bitcoin. But every time I buy groceries, I use my Coinbase card and I pay with stable coins. That has value. So we also need to think about needs and wants. People want a big nest egg. Okay, they're going to look at value differently. I need to put a roof over my head. I need assets that I could pay my landlord. Okay, we started with trading livestock. We moved to metals. We got to paper. We trade commodities. We trade services. Hey, if you cut my grass, I'll come over and fix your AC. So thinking about value is really important. And again, value is in the eyes of both the asset holder and the audience, the potential transactee, so to say. And it entails negotiation and agreement and standards. So a lot of what we're going to talk about today is standards. So let's get into some specifics here about, this taxonomy of different types of digital assets. Okay. We have stable coins, ecosystem tokens, that are like the gas and the staking asset. We have protocol tokens that are distributed by different projects and applications. Meme coins, of course. In my opinion, those last 2 things are pretty much the same. We have this, very bloated term that's gotten bloated in the last 8 months to a year, which is RWAs, real world assets, which now has all kinds of different categories embedded and some very interesting new ones. in the face of the Clarity Act that are coming out. I'm fascinated by tokenized deposits. I think that is something that is going to have very interesting conversations around it in the coming years. So there's lots of different, tokenized assets. There's lots of different digital assets out there. So let's first talk about stable coins, because there's a handful of different kinds of stable coins, and it's important to know what's behind them. People use stable coins because it's like, it's backed, it's safe, it's regulated, it's secure, I could spend it like anything else. There's an audience of people, which is fairly, your net new users, the people that are crypto curious, or I want to get in, or what have you, or I live in Nigeria, I work for an American company, I live in India, I work for an American company, and I don't want to have to go through all this off-ramping kind of stuff. I'd rather just get paid in stable coins, but I want to know that there's something behind it. Or there's countries that are like, I'm going to use US dollar-backed stable coins as a hedge against inflation in my own country. So there's some of these different advantages. So we have fiat backed, which is basically backed by the currency of that country. US is, we're all familiar with USDC, USDT, etc. These are backed by cash or increasingly T-bills. I'm not going to explain to you what T-bills are, but I always get asked, how do stablecoin issuers make money? Believe me, look at who's making the most money right now in this industry. Oh, but they only swap one for one. Make no mistake. Okay. Encourage you to look at how USDC makes money and where that money goes. It is actually extractive of certain ecosystems and fruitful for others. So if you know about T-bills, they're basically, I'll give the US some money, they'll give me a T-bill. Like we used to call them bonds when I was a kid, saving bonds. And at the maturation date, I'll get my money back plus some predetermined amount. So you could do this in different increments of time. And so these companies that are holding these T-bills are both satisfying their regulatory responsibility to back one-to-one, while also making money on that backing because they're helping the US government. You also have crypto-backed, less stable. I was head of operations for a startup years ago, and we were building a dual mechanism, which will sound like that third option there, but it wasn't. But it was a smoothed coin, which is similar to a stable coin, with a token, with an value accrual mechanism token. The less volatile this industry gets, I think the more you'll see these crypto backed. But as long as these heavy swings are happening, I don't think anything more than DAI will be, as widely accepted and used. DAI has been around a long time. And then you have the algorithmic. If the algorithmic stablecoin model is interesting to you, many of you probably have heard of Terra Luna. Okay. But there was also something just before that called Iron Finance, and their token besides their stablecoin was called Titan. Okay, it's about 2021 on Polygon. These are both the same story. These are both, seigniorage, value accrual token, stablecoin, mint burn, etc. And both stories have a bad ending. And by the way, I was part of both bad endings. So, but even though I went through that, I still think there's a potential and there's a world where someone's going to design this properly. I think that's going to happen. I think we're getting closer to the viability of that kind of stable coin. But at the end of the day, all of these are stable coins. They are pegged, which means they don't, vacillate too much off of that one-to-one. little bit here and there, which creates something called arbitrage, where people make a lot of money and it helps the stablecoin remain where it is. But that's, I don't want to get into the weeds there. I want to keep going. Proof of work, Bitcoin, granddaddy of them all, proof of work. Simple concept on proof of work is what's backing it is the energy, the little literal energy, and the effort and the challenge and time that miners put into, mining these coins, which they also get paid in, and also allows the Bitcoin ledger to continue to run automatically. There are others with interesting design. Recently, you have seen a little bit of an emergence of something called proof of useful work. Bitcoin is solve a silly math problem with your hashing machine, and you get the block. Well, that's not useful work, and a lot of people think that that is not eco-friendly because it's wasting a lot of energy. Some of the AI-based blockchain projects now have proof of useful work, where instead of grinding that ASIC machine and hash rate for a silly puzzle to get a bunch of zeros at the beginning, what's happening is it's actually crunching important work, crunching important data, crunching AI-powered data and compute that fuels a network and fuels an industry AI that needs that kind of compute. So if you're interested in this kind of thing, proof of useful work is the concept. Friends of ours at Ambient XYZ are pioneering a lot of this. And in our YouTube channel, there's a good little presentation from Travis from our Cortex Connect. Proof of stake is what probably most people are familiar with besides Bitcoin. Okay, simply, proof of stake is we are using financial tools to secure a blockchain. None of this is financial advice, by the way, but I will say that in my opinion, as an old guy, staking an asset with a delegator and earning block rewards in kind in that asset is the closest thing to owning stake in a company. Okay, because it's really, in my experience, it's the only asset in this industry where you could buy something. You are subject both to the price action up and down, but also you could do something with it. There's a benefit of having it by staking it with a validator and getting rewards. So while you have no real influence on whether the price action goes up or down, you are always growing the quantity of assets that you hold. Okay, so that is proof of stake. These are assets that are really, it's Sol and Mon and ETH and any L1 blockchain that requires you to pay in their asset for transactions and allows you to stake that same asset to, quote, secure the blockchain. Not going to do staking 101 today, but also receive rewards. Okay. Real world assets and tokenized finance. This is the big stuff over the last year. The closer we get to regulatory clarity in the world, the closer we get to traditional finance saying, you know what, we're going to go on chain. We're going to use familiar assets to our audience. We're going to offer them a better rate and better speed, better UX. We're also going to make more money because this is a better, more efficient, cheaper, faster way to do business with transacting with these assets. So that's what RWAs are. It's become almost an umbrella term. And like I mentioned, I think that tokenized deposit column is the one that's really interesting now. And briefly, because it's very new. Like this has popped up in the last, month, maybe. Because banks are going to probably take a hit with the Clarity Act and stable coins and so on. they figured out they could just tokenize the deposits. Someone deposits in their regular bank. I go and put a deposit of $100 in my local bank, and I can get an actual token to use on-chain in on-chain activities that's a representation of that deposit. Now I lose my deposit because they're connected, but the banks now can play this game and bring their business on chain without sacrificing people depositing with them. I love this. You know, personally, I'm an adoptionist. I feel like this is an opportunity for any reticent, skeptical person in the world to say, you know what, this is interesting. I'm going to go get, I'm going to get a token of my asset. I know it's in the bank. I trust the bank. I've been with the bank for 30 years. If they're giving it to me, it must be safe. I have other feelings about that, but I'm not going to comment. So that is kind of the rundown of all the different assets that are down there. And what I want to do now is I kind of want to pause before we get to the framework, turn the floor over to Ella, who's going to give us a really thorough lens into regulation and compliance. Ella?
Great, thank you, Jeff. Good morning, everyone. My name is Ella Wolf. I am an international legal and business advisor for AI and blockchain industries, focusing on compliance and global risk assessment. And I'll be breaking down how digital assets are defined and regulated across two dominant global jurisdictions, the United States and the European Union. One thing to note before we get into it is, as digital asset markets mature, navigating these legal frameworks isn't just a compliance exercise, and it directly dictates how you design products, structure tokens, and also manage cross-border operations. All right, so to first understand the US landscape, we have to look at two foundational legal pillars, the Supreme Court's Howey Test and the Genius Act. The Howey Test is established in 1946 and determines whether an asset or arrangement is an investment contract and thus a security. Howey checks four different prongs. The first is an investment of money. The second is in a common enterprise. The third, with a reasonable expectation of profit. And the fourth is derived primarily from managerial efforts. In contrast to Howey's flexible case-by-case approach, the Genius Act creates explicit statutory rules for payment stablecoins. It defines them as digital payment rails backed one-to-one by liquid cash or treasuries and issued by permitted entities, explicitly carving compliant stablecoins out of securities and commodities law. Evaluating our first two asset archetypes under the US regulatory matrix highlights a stark contrast in legal approaches. So under the Genius Act, payment stablecoins carry high legal clarity. They're classified as payment instruments and carved out of federal securities laws, provided they are issued by permitted entities and backed one-to-one by cash or short-term US treasuries. Now, the key rule in our matrix is that issuers cannot pay direct interest or yield from reserve assets to token holders. The yield must be handled by third-party banking products, which keeps the coin itself purely as just a payment rail. Next, for ecosystem and staking tokens like Ethereum or Solana, the clarity is more so moderate to high. Regulators view base layer 1 tokens as non-security digital commodities once a network is sufficiently decentralized, and native single node validation is fully permitted. However, the major friction point on our matrix lies in staking derivatives and pooled yield schemes, which the SEC tends to heavily scrutinize as potential investment contracts underneath Howey. Next slide, please. Zooming in specifically on US stablecoins, I'm just going to break down the statutory structure established by the Genius Act for this. So under this law, a payment stablecoin is explicitly defined as a digital payment instrument obligated to be redeemed for a fixed monetary value. To legally issue payment stablecoins in the US, entities must qualify as a permitted payment stablecoin issuer, either as a subsidiary of an insured depository institution, an OCC-approved non-bank trust, or a certified state-qualified issuer underneath the $10 billion cap. And this law imposes strict standards. Reserves must be held at least 1-to-1 in US cash, demand deposits, or short-term treasuries, with monthly certified disclosures. Crucially, the Genius Act strictly prohibits issuers from offering interest or yields directly on reserve assets. This preserves stablecoins purely as a cash equivalent medium of exchange and keeps them distinct from deposit accounts or securities. Next slide, please. Now, surprisingly to some, meme coins enjoy high regulatory clarity underneath US securities laws. But because most meme coins lack a core management team driving intrinsic value or executing a corporate roadmap, they tend to fail Howey's fourth prong, which is profits derived from managerial effort. So while price volatility is high, securities compliance overhead is very low, and they function essentially like digital collectibles. Real-world assets like tokenized private equity, real estate, or debt are more straightforward, and they are considered tokenized securities, with issuers having to register with the SEC or utilize established exemptions like Regulation D or Regulation S, with secondary trading restricted to accredited investors on licensed ATS venues. Next slide, please. So to round out the US framework, DeFi and governance tokens operate on more of a case-by-case regime. Regulatory classification hinges on functional utility versus a profit expectation. A pure governance token that only grants voting rights on protocol parameters generally maintains non-security status. However, the moment a protocol activates a fee switch, where it's routing protocol revenue or trading fees directly back to token holders, it does risk triggering an investment contract classification underneath Howey. All right, we're going to turn our focus to the European Union now. So unlike the agency by agency or state by state landscape in the United States, the EU operates underneath MiCA, which is Markets in Crypto Assets, a single codified rulebook applying across all of the member states. So taking a look at our complete EU regulatory matrix, you can see how European authorities systematically categorize each specific asset type. One thing about European regulation is that it tends to center on explicit upfront codification. So stablecoins fall underneath strict authorization regimes with a total interest ban. Ecosystem tokens require standardized white papers and ESG reporting. Meme coins transfer surveillance obligations to exchanges. Real-world assets bypass MiCA entirely to sit underneath traditional MiFID II securities rules. And DeFi protocols receive exemptions only if they achieve true, uncompromised decentralization. Next slide, please. Perfect. So taking a look into these specifics, MiCA provides exceptionally high clarity for stablecoins. So it divides them into e-money tokens, which are pegged by a single fiat currency, and asset reference tokens, which are pegged to mostly asset baskets. Both of these require full issuer authorization, one-to-one reserve backing, and they also face a strict ban on interest payments. Unlicensed stablecoins are outright prohibited from EU exchange listings. Before layer one ecosystem tokens, MiCA tends to classify them as other crypto assets. So to list them on EU venues, issuers or exchanges must publish a standardized MiCA white paper for them. But additionally, the EU introduces mandatory ESG disclosure rules, which requires issuers to publish data on consensus mechanisms, network energy usage, and carbon footprint as well. So meme coins in the EU tend to carry moderate clarity underneath MiCA. So if they're launched by an identifiable entity, the standard white paper rules apply to it. However, organic or issuerless meme coins receive the white paper exemption. And in these cases, the compliance burden shifts directly to exchange venues, which bear market surveillance liability to prevent insider trading and market manipulation. Crucially, tokenized financial instruments such as tokenized stocks, bonds, or fund shares are explicitly excluded from MiCA, and they instead fall underneath MiFID II, which is the EU's legacy regime for traditional financial instruments requiring full prospectus registration, institutional custody, and licensed investment firm oversight. Next slide, please. So finally, on the DeFi side, MiCA explicitly exempts fully decentralized protocols that operate without a central controlling body. However, European regulators actively enforce what we call a facade warning. If a core development team retains the administrative keys, developer backdoors, or dominant voting power, the protocol does not qualify for the exemption and instead will be brought fully within MiCA's regulatory scope. Next slide, please. All right, so to summarize everything, while the US framework balances statutory bright lines like the Genius Act with flexible core-testic frameworks like Howie, the EU offers a comprehensive upfront regulatory code through MiCA. One thing to note is for global operations, success ultimately comes down to aligning your token-specific mechanics, such as fee switches, yield distribution, governance rights, and administrative keys with these distinct regional realities.
Thank you, Ella. Excellent, as always. Appreciate that. This kind of work that Ella put in, that she just shared with you, is integral to everybody. As we start to develop and design products, as our working group works on open source software, one of the things that we are having everybody do is annotate your code base according to what's relevant for regulation. So you could go into open source software and see a DeFi smart contract, and if it came from one of the Cortex teams, you're going to see annotation of this is, Genius and MiCA compliant because. When we diagram architecturally, we do the same thing. So let's dive in a little bit differently now that we have a lens on what the type of assets that are available are and the regulatory components thereof, to look at a framework of how would somebody design this. And really what this framework is, it's more of a high-level way to think about different categories, to have discussion, and to make sure you're considering all the components in delivering good tokenomics. Some people would laugh at that last phrase, good tokenomics, and say that that is an oxymoron. The reality is that the bigger the audience of people using your asset for whatever reason, the more people are going to not be happy with how it works for them. So that is kind of part of the process here and part of the thinking. But if at the end of the day, you simply plan each of these domains thoughtfully, and again, ask really good, hard questions of yourselves and talk to users, you have a better chance of offering a good tokenomic model to your community. So it really comes down to, it's actually 8 things. It's an 8-part framework, but Ella really just nailed 2 of them. So I want to focus on these 6. These are the 6 areas that, as a token designer, as a project launching a token, regardless of your purpose, these are the things you need to consider. Okay. And I want to actually use a protocol token as the model because it is probably the most commonly frameworked type of asset. And when I say a protocol token, I mean, I built an application on such and such blockchain, and I want to offer a token to my users. Okay. Now, this is tricky, and I'm going to be super candid here. I don't know what the percentage, but a lot of projects offer a token as a fundraising mechanism. Okay, we're going to launch a token. It's associated with the hype of our product. Really, there's no real utility to it, or we could try to build utility into it. I don't know how many people, how many projects have really done a great job of relevant utility. It's a really hard thing to do. Okay, and I'll show you a couple of the ways people have tried, but the idea that teams offer it, there's hype, price goes up, vesting cliff hits, they dump, and that's how they pay themselves. And I don't say that critically, because launching a project and trying to sustain it is really hard work, and people that do it need to get paid. But at the same time, your audience, invariably, your uneducated audience, your community, your users, associate that protocol token with ownership of the outcome of the project. And it's just not true. Right now, there are some excellent projects out there, whether it's L1s that are doing incredibly well, or individual applications that are doing incredibly well, and their token price isn't demonstrating that, and there's no dividends on a protocol token. So users and community are, crying on socials, make the token go up. What's wrong with the project? The token is down. Well, they're not related at all. If I built, Jeff protocol, and we've got millions of users, and people are doing really, really well with the actual product and what it's designed to deliver, that has no bearing on whether the asset's going to go up or down. And if it does, it's just emotion and speculation, because there is no real correlation between project success and token price action going up. And there are tons and tons of good examples of it. My favorite DeFi protocol, not financial advice, is something called Camino. Camino's token is not worth anything, in the grand scheme of things. But for me, it's the best DeFi protocol in the industry. It's purely opinion. I don't use a lot of DeFi. But I say that because, it's just an example. And there's many, many of them. Thinking about another project, just to call it out, Arbitrum is an L2. It's doing incredibly well. Token hasn't moved. Tron, an immensely successful, profitable L1. It is like the primary USDT rail. Successful for years. Token hasn't changed. It's staying at that same price no matter what. So there is no correlation. And I just want to emphasize that, because that, at least heretofore, is a losing battle. So let's get into a little bit, the going back again, these are the 6 things I want to kind of dive into. And I'm not going to go through each one of these elements on the slides. I'm going to talk at a high level. Decentralization. This matters. This matters for the simple reason that a lot of people get into this industry. A lot of folks enter as investors, as curious, trying to make money. And they do so because they want to interact with something that is not going to be shut down as a single point of failure. Okay, it's not a single data center. It is not a building in downtown Lagos. It is not, that the government can come and shut down and I lose my money. It is decentralized. And decentralization at its base layer means that there are computers, nodes as we call them, around the world talking to each other that all have this application on it. So a whole country can shut down access and it doesn't go away. So that decentralization piece matters. The other part of decentralization is decentralizing the asset itself. So if we're going to offer a token, it can't be all in one group's hands, either at the beginning or at the end. You know, a lot of these projects, as you know, we'll talk about vesting cliffs and founder and early supporter lockups and so on, where, you know, the tokens are trickled out over time. You never want too many assets to be in too few hands, because then they control the asset. It becomes centralized. The project itself can be decentralized. The asset itself is not. One of the things that there's been a lot of experimentation with is, you know, governance. You hear DAO, you hear, you know, you can use this token. It's one of the utility pieces that we'll talk about in a minute as a voting asset to direct this, quote, decentralized platform. And it is, I don't think it's been gotten right yet. There's people on this call that are excellent scholars in this area and have done a lot of work with it. I think its day is coming. But I think that it's going to require a lot of adoption, and the value being in the vote. You know, if you say this token is giving you a vote, there needs to be a value behind that vote. So we want to make sure that, you know, it's decentralized physically, and that the distribution of the asset is also decentralized. And even if there's initial airdrop or sharing or what have you, where, you know, if you're going to give your early supporters a reward for participation, they're going to have more, theoretically, than other people. You're also going to have people that are, quote, bullish on your project. They're going to want to accumulate a lot, feeling like they'll have more influence over the project. These are things you need to think about. And, you know, one of the things that I say all the time is, how will people game this? How will people try to take advantage of the rules and give themselves an advantage? Because if there's a way, it will happen. So, you know, these are the kinds of things you want to protect: the decentralization of the distribution and the holding of your asset as best you can. Transparency. Again, in a lot of places around the world, people are using blockchain to escape corrupt financial systems. And those corrupt financial systems are typically so because they lack the transparency. Okay. What's happening with my funds when they are in a bank or in this or in that? So, you know, the beauty of blockchain is everything's on chain. Everything can be found via an explorer. Some people think that's a gift and a curse, but when it comes to tokenomics, transparency is integral. You know, you can go to CoinMarketCap right now and you can see exactly how many assets have been distributed, you know, how many, 1 second, let me admit somebody here, you know, when they're getting unlocked. People look at when assets are getting unlocked in large chunks because they can expect price action at that point in time. So transparency is really important, and especially that second bullet point, which I was just talking about, clear vesting and unlock schedules. I mentioned earlier, there are teams that use their token to raise funds, to get a big cash flow and a big influx of liquidity early on, whether it's to bootstrap the protocol or to pay themselves. Both happen, and probably other reasons. And sometimes people will see a project losing momentum and identify at the point in time where all the assets will be unlocked to team and investors and say, I want to get out before that, because I feel like we might get dumped on. This happens all the time. It is unfortunately a black mark on our industry that people do this and rinse and repeat. Really good developers and builders build cool things, grow a lot of hype, offer a token, leave the protocol running, and walk away with the token funds. Because again, like I mentioned earlier, there is no correlation between the quality of a project and the price of its asset. None. In fact, with L1s, developers actually prefer a lower token price, because every time you do a transaction, it costs you money. And loading a project on chain is a transaction. So if I'm building on a protocol like Ethereum, and it's $1,900 a token, that is cheaper for me than when the token is $4,000 or $6,000. It's never hit six, but hypothetically. So these are things to be aware of. Have everything transparent. Just make sure anybody can see anytime. Supply dynamics, incentives, and utility are probably the trickiest ones. How many? This is the short, medium, long-term way of thinking. How many assets are we going to mint? On a personal level, nothing drives me nuts and feels way too familiar as an American than to see no supply cap listed. Like, we can mint as many as we want. I mean, that's a problem. That's a dynamic that a lot of people are in this industry to try to get away from. Okay, one of the real magical appeals of Bitcoin is there's 21 million and that's all there's ever going to be. And we know what that unlock looks like. We know that there's no investors that need to take it and dump it. We know those things. There's a real scarcity value of Bitcoin. I did not say that, David. So, I like when a team is thoughtful about maximum supply, circulating supply. I think that's an important thing to consider. It does invite that early adopter emotional response of, I need to be rewarded more because I bull posted about you on Twitter. Running a project, running a startup, building tokenomics is not for the faint of heart, because you will be dealing with a lot of people's emotions, people that are not schooled up on what you're trying to do to understand your long-term vision. You also need to bootstrap liquidity in many cases, okay, especially in DeFi. You need to have liquidity for people to be able to interact with your application. So yeah, people want something for all the time. The other thing, Taco, is the idea that people think that bull posting on Twitter for 3 months is working. That's a hobby. But the important thing here is ask all the really hard questions, not only thinking about attracting early users, but what happens next? And after that, what are you going to do? Have a plan. Okay. Don't have a 1 million asset circulating supply knowing you're going to mint another token and not tell anybody about it. People do that too. And that makes the initial token worthless. Security, obviously, one of the things that I jokingly say is, when you architect out anything as a design, you want more boxes than arrows. And maybe not in some architectural designs at the technical level, but at least in high level, the more arrows you have going between things, the more attack vectors you have. So, over audit. Again, I mentioned Camino early on. One of the things I really like about Camino is they are constantly getting their contracts and their practices audited. You're fine, Taco. Constantly. And the other thing is this, we're announcing within a couple of hours after this, our first big partnership at Cortex with a major security firm. And so keep an eye out for that. It's very exciting for us. It's not just smart contract audits at this point in time, it's DevOps. Make sure you are very transparent, going back to the previous slide, about key management. Most of the recent exploitations have not been smart contract related. They've been key management related. And way back when AI started to really ramp up, that was one of my primary concerns, was you have people that are operating without the understanding of good key management, and they're using AI and things are slipping through the cracks. But the other side of it is also the social engineering stuff that's happened a lot, and it's always around key management. And there are ways to mitigate that. And unfortunately, a lot of those ways are emerging in real time because it's don't do what we just did. Okay. So security is integral, especially in the adoption age where we are attracting new users with every passing day. The other thing is Oracle and other integration. Okay, the drift hack on Solana was a great example of this. I have friends that have live mainnet applications whose projects went under because they were integrated with a protocol that got exploited. So I've got a personal rule, and Jenny on the call here is probably going to laugh. If you're a startup, integrating with another early stage startup as something that is integral to your project might not be a good idea. Because if they pivot or don't do well, you're now tied to them. So be really thoughtful about Oracle security and dependency security. Ask those hard questions. Do your due diligence, hardcore, on who the people are and what they're building at these other integrations. The big one, incentives. Look, incentives exist because you got to get users. And the way you get users, especially if you're doing something similar to somebody else, is to sweeten the pot, attract them. And a lot of people in this industry, they get attracted by financial incentive. Don't design this in a way that you can't sustain. Don't design this in a way that is asynchronous from one month to another. Don't design this in a way that you're so eager to early on have a big influx that you can't later on do anything. Okay, this is really, really, this is one of the hardest things to do, is to design incentives. And again, it is, who is your audience? What inspires and touches them emotionally to keep them with you? What logically keeps them with you? But what will allow you to also draw new users later? Sustainability. And again, there's a lot of projects that don't care about this. We want a lot of people coming right now using it, pumping our token for the next 18 months until our cliff, and then we're good. They can use the protocol they want. It's live on chain. It's automated, blah, 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 blah. But if you're serious about creating a product that serves people for a long time and retains its user base, incentives need to be thought out short, medium, and long term. Now, look, short term might be 40% of that process, or 50% rather, and medium might be 30, and long term might be 20%, because you got to get to the long term. You got to be able to get people in the short term to hit the medium, and you got to retain them in the medium to hit the long. But you got to consider all. Finally, utility. Utility is tricky, especially since I don't think anybody has found a way to really craft a relevant utility beyond financial incentive for their token holders. Whomever does this well is going to do very well. If you could get the incentives balanced and have real utility, Okay, I could do something very real with this token. The example I always think of is if it's a trading platform, and I think Hyperliquid does this really, really well. By the way, Hyperliquid's tokenomics are probably the best that have come out in the last couple of years, in my opinion. Again, not financial advice. The idea is, can you pay for transactions? Can you trade that asset that you hold for something that you want? Right? Go back to the beginning. Or need. I'm a power user. I need this token to do X, Y, Z. It's why proof of stake platform tokens have value. I could do something with it. It lets me do transactions. I could earn in quantity by staking. I could do something. Now, a lot of protocols have staking, but they don't have the piece of value. Like, okay, so now, look, I've got, 3,000 Camino tokens because they're being staked, but the token doesn't let me do anything with it. Okay. All right. So that's kind of the framework, and the slides are in the chat, and I've got a couple other different models that I'm happy to share as y'all request. But what I want to do now is I want to turn the mic over to David, who's going to get into some real granular, in real time, happening right now uses of this model and of thinking about tokenomics. David?
All right. Thank you, Jeff. Appreciate you. David Carter here. And just by way of, sort of throwing out my patents of nobility, I've been involved in this industry intermittently and in direct projects since about 2014. Currently working on several projects that are connected to tokenomics, and some of them are extraordinarily new, as in we have yet to actually properly figure out how to do it in a way that aligns well with the body of work. But this work is both active, and one of the things that I spend the vast majority of my own time on, particularly when working with projects that are focusing on constructing some type of model for distribution around tokenomics, are the intangibles. And over the years, this document has been refined. And if Jeff gives me permission, I'm actually going to show off this document. And I'm also going to go ahead and put a link to this document here in the chat that anybody can have. But what we tend to do with these projects is we ask 5 fundamental questions. And take note that none of these questions tell you exactly what tokenomics model to use. What they do is they put you in a position where, instead of thinking about the spreadsheet itself, to think about the design of the way that you engage with your project explicitly, both in the public, but also within the context of governance, within the context of construction, and within the context of rule changing and making. And so there's really these 5 questions that we push towards, and they're centered in these like I think of as easy to drive through categories: legitimacy, narrative, distribution, reflexivity, and credible commitment. And what I'm going to be doing here with you is just walking you through some real world examples of each one of these categories and how that particular question got answered when something for real actually happened. And then when we're through with that, what I'll do is walk you through an example that we're working on right now in our body of work at Threshold Partners that we haven't figured out yet. Like, it's something that we're trying to figure out. It's something that's fundamentally fresh, and we're not exactly sure how to engage with it. But our operational hypothesis is that the token, in order for this particular token to work, it's going to have to be centered in reputation as opposed to, centered in direct value, which is tricky because the project is focused on scientific research. So that being said, under legitimacy, the core question is, if you change this rule on any given day, how would people react to that rule? Would people leave? Would they shrug? Would they attack the network? Would they completely try to, to fork the project? Whatever the potential outcome might be for a given project. And so there's two examples I want to give around this. And fortunately, all of these are look upable because these things have already happened in the past. And you can go and engage in getting deeper research on any single one of these as you're doing your own tokenomics research. The first one is centered in the DAO, which is fundamentally connected to Ethereum and its fork into Ethereum Classic. So back in 2016, they had a real world test. About 10,000 or so individual people put about $170 million into the DAO itself, and an attacker drained $60 million worth of Ether straight out of the project. And it caused not only drastic news and engagement in the industry, but that was almost 15% of all Ether that was available at the time in 2016. And so what the community ended up doing was forking the project. Well, I shouldn't say that. That's what I should say is that they reconstituted. They actually changed the code to reconstitute those funds back into the project. But it actually caused a rift because the attacker actually did this by way of executing legitimately within the rules of the code itself. And so it caused this rift in the community that said, like, hey, if this code is executable in this way, this is the price that you have to pay for not having code that protects from these types of barriers. And so the consequence of that was that Ethereum forked into two explicit projects, the Ethereum that we know today, and there's also still to this day Ethereum Classic. And the bottom line is that it survived. So from a legitimacy perspective, the change stuck because most of the participants believed, hey, this person stole this money. We should do something about it. And the vast majority of individuals that were participating in Ethereum, including myself, stuck with the fork by virtue of the fact that this theft was a function of the fact that the code itself allowed this exploit. But from a constitutional perspective, theft is theft. And like, what are we going to do about those sorts of things? However, there was a minority of individuals who said, look, the code is the code. You have to abide by the rules that you set. And therefore, this attention in that ecosystem got split fairly drastically. And that Ethereum Classic network still functions and operates to this day and is still available to be invested in, participate in, and even build on. And some people still do. So something to keep in mind there. Another example, for those of you that have been around for a while and remember Steemit, a gentleman by the name of Justin Sun back in 2020 came in and for all intents and purposes acquired Steemit. What Justin did was he purchased roughly 74 million Steem and for all intents and purposes took control of the platform itself as a function of this acquisition. The problem is that the users hated that by a lot. And so in the act of going through this particular, for all intents and purposes, acquisition, the vast majority of those users, for all intents and purposes, left and created a new network for social media and conversation and distribution centered in something called Hive. And that duplicate excluded Sun's tokens directly. And within a week, Hive outperformed Steem. So it didn't take long for all of Steemit to start to collapse from a value perspective and Hive to become, the primary driving force where individual users that were creating content actually were capable of getting value from their contributions to the body of work. So even though Sun had legal ownership, he did not have legitimacy. And so the community left with the community that was producing the content left with the actual values. All the writers, the developers, the culture, they all fled. And in fact, this particular case study gets taught at Harvard Business School and a bunch of other universities as an example of how just because you can doesn't mean it's going to work. And the act of trying to acquire this particular social media network for all intents and purposes, resulted in some pretty harsh schisms in the way in which this kind of social media content. In fact, it has, in a lot of ways, to my mind, and this is, opinion, not necessarily an observed opinion, but not necessarily fact, has really kept a lot of social media networks from taking advantage of and using, tokenomics architectures for their development ecosystems. There was another one that was built, and I was a part of the conglomerate project, but I didn't work on this one specifically, called Voice, that attempted to do it again in its own way, by doing curated social media constructs to add value to individual creators and artists. That again just didn't work because they couldn't construct a legitimacy and generate the value. So the big lesson, here for the room is that legitimacy is really what remains when you subtract legal authority. Folks like Sun proved that you can win the vote, right, but lose the network. And so legitimacy is a big consideration inside the intangibles, and it's something to give a lot of thought to when you're designing your tokenomics ecosystem. On the narrative front, and when I think about narrative, it's really about how simply can an outsider explain what's happening on the inside. And when I think about those things, like how quickly can they do it in a sentence for all intents and purposes? And I've got two examples here. One is a success example that goes a little bit against Jeff's earlier comment about unlimited token supplies, but the other one speaks really well to the fact that they had actually constructed something that was real and physical, but still really didn't make it. And the first one centers around Dogecoin. So when you think about the narrative around Dogecoin, it was created as a joke. It has no supply cap, no utility claims, but it's somehow managed to survive 12 years, multiple cycles, including obituaries. I still pay attention to the number of Bitcoin obituaries that come up. But the same thing's true for Dogecoin. There's been many obituaries describing it as being done and finished, but it still ranks among the largest assets by market cap, which is kind of interesting because you say, well, if this thing doesn't make any claims to utility, it was made as a joke, how is it that it actually manages to stay a force within the ecosystem? And it just demonstrates that narrative alone is oftentimes sufficient for persistence. It's sufficient for survival. When people explain it, they're like, it's a dog coin, it's a joke, and it's fun. And that's pretty much it. And it's not to say that people don't build anything on Dogecoins. Some do. But the reality is that because it doesn't make any falsifiable claims, it propagates with no friction. And for all intents and purposes, there's nothing for reality to contradict in the notion of Dogecoin. And so from a narrative point of view, it does work because it functions itself as one of the first declared sort of meme coins that still operates today. So lot to think about in those kind of stories. On the opposite end of the spectrum, Helium is a project that I really, really, really desperately wanted to work. When I think about decentralizing access to infrastructure, when I think about what it means to give people control over the infrastructure that they provide in their local communities, providing access to Wi-Fi, providing access to wireless networks and cellular networks in a highly decentralized and openly governed way, I love this concept. Helium, from a practical point of view, was a beautiful idea to construct an open wireless network for the world. The funny thing is at the very beginning of it, hotspots grew from 0 to over 450,000 by by the end of 2021, peaking at around 1 million in early 2023. But the problem with it was that the actual revenue that was being generated by the individual investors, like people who bought infrastructure, like literal physical hardware, put it in their houses and even got their neighbors to get involved and do it, weren't actually extracting the rewards. They weren't actually like the actual narrative within this thing was that, hey, if you invest in this and you actually put your infrastructure up, it is going to result in you being able to profit from that that investment and be able to participate fundamentally in what it means to drive an open source network for the masses. It didn't function correctly as an individual unit for individual investors, and even for people who invested in it as businesses. And I'm aware of several of them who bought hundreds of these units, distributed them around towns, and fundamentally lost their shirt from a narrative point of view because it never actually returned the dollars from a usage point of view that they thought. So they did a really good job in the narrative of getting people that understood, like the nerds who truly understood what it meant to build this open network, but couldn't get actual public adoption to truly engage with this network for lots of reasons that we could go into all day that we're not going to. But bottom line is that, you know, the lesson of this is that, you know, for Dogecoin, the narrative can't be falsified, but Helium's could be, because you could see whether or not your investment into the network and into the extraction of tokens via people using your infrastructure was going to work or not. And so if you, in your sentence for your tokenomics, for your ecosystem, if you make a claim, someone is going to check it. Someone is going to test it. So the thing that I talk to a lot of groups about when they're making claims is, what is it going to feel like when it's tested? And ultimately, the real question is like, can an outsider explain why the token exists? Because if they can't, then we've got a real problem. So in distribution, it's very simple. Who holds this in year 3, and why haven't they sold? And when I think about those sorts of things, there are lots of reasons why people don't do that. You actually heard Jeff describing several of the ecosystems that he's participated in over the years. I've participated in a bunch of these. I have this rule when it comes to my own tokens that I engage with. And so that if I can't use it for something, then I'm not going to acquire it for anything. And for me, that makes it easy. It means that I tend to get involved in tokens that have some type of actual output in the real world in some way. It's why I participated in Helium, quite frankly, and invested in hardware and infrastructure, because the vision of that body of work from a technical point of view really worked, but the vision from an actual user point of view simply just did not work, or did not work well enough to sustain the network. Now, the examples for distribution are a little bit different, because many of these are actually active as we speak. And there was one in particular in 2020 that's really worth bringing up here. So for those that have been around for a few years, back in September of 2020, Uniswap did an inordinately large airdrop. And their motivation was to, for all intents and purposes, buy into user adoption. And what they did was they deployed 400 tokens to over 250,000 addresses. And at the time, each of those tokens was about $3. And so these folks, for all intents and purposes, were given $1,200 in order to start taking advantage of and using the network. But by the end of 2022, less than 7% of those originally airdropped wallets still held any Uniswap at all. And when you think about that, like think about it from the perspective of, if you're trying to get user adoption, what a lot of traditional businesses will do, and even Web3 businesses will do, is they'll engage in some type of cost of goods sold or cost of acquisition of a user. And in terms of cost of acquisition of a user, spending $1,200 on 250,000 people and $1,200 each, and losing 93% of them over the course of the next year and a half does not speak well to return on investment. And so from a distribution point of view, this particular decision on their part turned out to be a pretty colossal failure, and didn't completely eliminate the network in any particular way, but their distribution model from an airdrop perspective fundamentally did not work, because they didn't retain almost any. They retained less than 1 out of 10 of the users that they gave those dollars to. And that's really something to be paying attention to in our tokenomics models. The other example in this is across a lot of networks, and I think is worth putting a little bit of time into. And so it's this notion of low float and high, like, fully diluted value launches. And so what I mean by that is, and you'll hear it called like low float and high FDV. So a float is how much of the token supply is available on day one. And the fully diluted value is like how many total tokens can be available in the midst of that particular ecosystem from a distribution point of view. And you're seeing this right now. Lots of tokens launched over the past few years that usually averaged around about 12.5 of the total supply at generation, leaving like, between 80 and 90% locked for future releases. Binance Research has done a ton of like good content on going through these cohorts. And the real challenge is that when you start to actually do the math, the amount of total investment into the fully diluted value of those tokens would be so high that almost none of those tokens could ever actually reach their fully diluted value or their fully diluted value targets. I think it was, I think in the Binance research, it was around 80% of the tokens listed had declined within 6 months of launch. And almost all of that was described as exit liquidity for insiders. And so something to give some real consideration to when you're thinking about how you're doing distribution. And I think it was like over 16,000 of those unlock events fundamentally turned out to be drawdowns. And so that's something to really give consideration to when you're designing these ecosystems. And like, here's the challenge, right? Like, if you want to do adoption, you want to bring folks into these ecosystems and into these networks, there are things fundamentally that we have to do. And so organizations like Uniswap, they chose well. They gave away the token in order to get people engaged in utilizing the network, but they didn't continue to retain the users. And so, like, who holds that in year 3 deserves a real answer from you when you're thinking about your tokenomics models. That's the real question you want to get answered before you start to release these into the public. All right. Reflexivity. This is the if everything goes to crap, how does it survive section. What I often like to do in terms of exercises with groups that are looking into this type of modeling for their work is like, what happens if this thing goes, loses 80% of its value? Like, what breaks if this thing loses 80% of its value? And the interesting irony in all of this is that many of these ecosystems do still survive. Like, they can survive these types of events, and many of them do. To Jeff's earlier point, many of these networks, the price of their token is almost fully disconnected from the actual success of the body of work that's happening within that project. And so I pay very close attention to those things. And as long as this question can be answered very well, those types of problems can be dealt with in the design upfront. And so when I think about those things, again, there's like two good examples here to give consideration to. Jeff was alluding to the first one. Terra Luna is a sort of like a big, it's one of those, what I would consider to be nuclear events in the ecosystem, where, that particular platform fundamentally did not run their model the opposite direction. And when they didn't run their model in the opposite direction and it happened to them, the whole thing collapsed. If I'm remembering right, and Jeff, correct me if I'm off base here, I want to say it was like Anchor that was offering like 20% APY. And I think they attracted like 70 or 75% of all of Tether's circulating supply. And by April of 2022, the price of Luna peaked at around 119. But between May 7th and 12th of 2022, the price fell from $1 to a penny on Terra.
Yeah, I mean, there was a lot of stuff that happened, but I mean, you know, the mechanism with Anchor and the fact that so many projects built on Anchor to access that yield were problematic. I mean, I was there in the middle of it at that time because that's where, you know, my previous project started. But the other side of it was very public conversation about moving liquidity in stable pools on Curve and so on, created an opening that was likely a big part of the exploit. But yeah, it was, which is why I said what I said earlier on. Like, I don't think that it is a model that is proven to be bad. I think the previous executions were faulty.
Yeah. I mean, I would say that the in their case, the mechanism that was designed to defend the peg, ultimately burning Tether to mint Luna, was the mechanism that destroyed it, as part of the way the narrative was constructed and the way that they actually made deals behind the scenes, not necessarily the structure of the actual architecture itself, but the way that the deals were made internally with these individual groups, like the Voyagers of the world, the 3 Hours Capitals of the world. Yeah.
It was a lot. There was a lot of stuff going on.
Yeah.
And I remember, it's one of my favorite stories. I remember the week after being in a call with like all the founders on Terra losing their minds, and Doe coming on and being like, everything's going to be fine. And everyone's like, Doe, you need to shut up.
Yes. Yeah. Oh boy. Interesting times. Yeah, interesting times those were. But there's another example here too, where the ecosystem did manage to survive the impact event, but it didn't come without cost, and it always does in these situations. So for those of you that are familiar with MakerDAO, they had what they call a Black Thursday event in March of 2020, and they had modeled this problem, like what happens if we have an 80% event, but it was expensive to do. And so back then, ETH fell, I think it was like 50% over a 24-hour period on March the 12th. It was a big deal, and it flooded the system with liquidations. Gas prices went through the roof. Keeper bots couldn't participate in collateral auctions. It was just a complete bloodletting of the bidder take collateral, just a whole bunch of these individual breaches in terms of value. I want to say inside of MakerDAO, it was just shy of, I know it was in the millions, not in the billions, but a lot of liquidations occurred in the MakerDAO community for almost none of their individual token. And what they did in order to survive this, because they had a model built in to do this, is their governance team actually approved sort of a last resort measure by minting new Maker tokens to recapitalize the system. Now, the consequence of that was that they diluted existing holders on purpose. That was the consequence. And the benefit was that emergency shutdown was averted, but they had to get USDC to add, they had to add collateral to the ecosystem. And so they added a stable coin to bring in as collateral, which a lot of critics, I think appropriately, described as, sort of making the central claim to being fully decentralized put into question. Because this thing was done for all intents and purposes at an extraordinary rush without the traditional voting architectures that would be used through their governance system. But it did survive because Maker did have a backstop and it did work. It cost the holders of Maker tokens some dilution, and it cost the protocol like their sort of clean narrative claims. But they did have a model down case for dealing with and escaping that kind of reflexivity. And the nice thing is that they've been able to actually modify their rules going forward and make it so that when these events occur, the ecosystem for all intents and purposes now gets to emergency deploy and create votes on the fly in order to deal with these events. And so these are just things to give consideration to, like knowing what can happen if this thing loses 80% of its value is something to give some real consideration to, and to just ensure that you're driving these possibles into what happens if it happens, as opposed to let's deal with it when it happens. Now the last one here, and this one, I think sort of ties back into all of these, because the credible commitment sort of speaks to all of these others. For all intents and purposes, and as an example that Jeff was bringing up earlier, Bitcoin's 21 million cap is probably one of the strongest credible commitments in the industry to date. And it has been challenged. It has been there's been many Bitcoin improvement proposals that have aimed to try to change those numbers, and they've consistently been defeated. And there's no person to lobby in terms of this particular commitment other than the actual holders of the tokens themselves. And no one has been willing to engage in this argument to the point of action outside of those that actually forked the protocol itself. Things like BCH and other ecosystems that have been created that are still within the context of that. And the impact is that this particular asset still is number one on the list, which is really surprising to me, because when I think about the beginning of the internet, I remember Yahoo and Ask Jeeves and some of the major search engines that were coming online, and they were the big thing. And Google was just in 1996 this tiny little scrappy startup. But the originals in that ecosystem, the Alta Vistas of the world, didn't actually survive contact with the way the environment changed over time. Right? Right? Wow. Yeah, I am old. You did say decades, and so you gave me permission, Jeff.
Yeah, man.
So from a practical point of view, I find that a big reason why Bitcoin's been able to do this has been that credible commitment to keeping the architecture and original design as close to intact as practically possible. There's another example in here, and Jeff spoke to it a little bit earlier, but one of Arbitrum's big initial promises was centered in the governance being voted on very much directly, and their first improvement proposal was a breach of that commitment. And the structure of that improvement proposal wasn't even a proposal. It was just a ratification of a decision that they had already made. And the decision that they had made was to send, I want to say it was 80 million. I think it was almost 80 million, it might have been like 75 to 80 million dollars into an entirely separate community, and engage in taking that community to fund the foundation, to give money over to an unnamed financial market community that I'm about 99.99% sure I know who that is. But the interesting thing about this was that in this particular improvement proposal, the big thing that people objected to is that there was a whole lot of actions that were inside this singular improvement proposal. It's called AIP1, if anybody wants to look it up. There were tons of things in there, and it wasn't designed as a proposal. It was designed as a ratification. And so it wasn't like, hey, should we do this or shouldn't we do this? It was like, no, we're doing this, and we just want you to say yes to it. And out of the 50 largest voters, I think 3 supported it. And so what ended up happening is that like the impact to Arbitrum was that over that weekend, it lost 20% of its value, went from about $1.40 to like $1.15, which doesn't sound too severe in some of the things that we've seen now. But it was a big deal. And what it caused the foundation to do in a really good way is to actually split the proposal. And then they actually had to vote individually. Like I think it was like, version 1.1 and 1.2. And like there was several iterations of the proposal that fundamentally forced the ecosystem to live up to its promises. And that was a good thing. Like for all intents and purposes, like from a credible commitment perspective, it put this institution in a position where it absolutely had to deliver on the things that it said it did or was going to, even though it tried to do something else. And that's a great use case for how do you design a governance architecture that forces the very foundation that's creating the work and creating the protocol to live up to the commitments that they say that they're going to. That commitment was only really tested once in that way. And the answer really arrived before the question was even properly asked. The price moved and the voters went very appropriately berserk. And it resulted in them having to truly rethink the way that they deliver proposals in the ecosystem in a good way. So, all that being said, these are the 5 top level questions when we're engaging with the intangibles on tokenomics that we get to engage with. And what it tends to force us to do is think carefully about governance, to think carefully about how we design failure modes, about how we handle things like distribution, floats, fully diluted value distributions, how we think about the narrative, like why does this token even exist? And how we think about, fundamental legitimacy, from a rule changing perspective, the whole 9 yards. Ooh, and you're asking that question at the right time, Taco, because we're now moving into Q&A. So
yeah. And the interesting thing, David, I'm gonna shift the slide back. Thank you very much, David. Sure. As you all can see, David's an expert on this stuff, and he's been around. And one of the things I said at the beginning is, read history. Know the history of this ecosystem, of this industry, and before that. It's funny because I think Rika, are you still on the call? Rika's, our resident expert on Arbitrum, and she's not. So Rika, who's part of Cortex Atlanta, she's actually one of the council people for Arbitrum. So she knows this really, really well.
Yeah.
David, what were you saying about it being current?
Well, no, Taco just started asking a question in the chat. There was one thing that I wanted to show off, which is like an active unknown.
Oh, go for it. Sorry.
So let me, that's okay, buddy. That's okay. So I'm going to show you an unsolved problem right now. And what's tricky about unsolved problems is that you have lots of opportunity to look at history, but you don't necessarily have tons of opportunity to, do nothing while you try to figure this thing out. And this particular project is for all intents and purposes, an open source science engagement. And the goal of this particular community is to study cognitive physics, which is a new arena of physics that includes consciousness in physics calculations for all intents and purposes. And this particular fund and governance architecture is fundamentally incomplete, but the current operational hypothesis, the thing that we're back testing right now, in the midst of this is coming up with a mechanism by which to keep the work legal to do and open to do, but instead of engaging in ecosystems like Research Hub, which is something that we could very easily do, or I should say we could easily do it with university affiliation. But what we want to do is open citizen-led science, because all of us are conscious. All of us interact with physics every day. And many of the best ideas that this community gets access to today, and this is an ongoing project right now, it just does not have any type of tokenomics layer for crowdsourced fundraising for individual experimental frameworks. And so this is a mechanism by which to create a funding architecture to fund scientific exploration. And we haven't yet properly figured this out. And so the thing that we're exploring is whether or not a nonprofit can be involved with a tokenomics project without creating undue risk. And our research tells us that there's nothing that we can do in the US framework that affords us the ability to allow the nonprofit to hold any tokens ever. And so from that point of view, that means we have to do something unique and different. And so the proposal in here is around this thing called the Veil-Break Commons. And it's built upon the notion of reputation. People who submit projects to the protocol, get those projects funded, and then their obligation is to report on the results. Doesn't matter whether they're positive results or negative results. It just matters that they're proposing a project that can be delivered on, that can be funded, and that ultimately can potentially create branch vehicles that can lead to interesting things like instrumentation or data set licensing or analysis software or whatever that can actually create equity or revenue share or potentially IP NFTs, like those sorts of things. And so from a practical point of view, like we've got these constraints, right? Like the nonprofit can't issue a speculative asset, cannot do it. At least not in the United States. There are other jurisdictions where like that's a bit more fuzzy. But here in the US, what OpenAI is doing is not legal. So like just throwing that out there. And rewards from this point of view can never really attach to administration because some of the research is attached to tryptamines, which in the United States, they're fundamentally illegal, but outside the United States, there are many jurisdictions that allow that kind of research to be done. And since tryptamines definitely affect consciousness and definitely affect the way outputs are created, we have to give real careful consideration to how this body of work is being done. And the other side of it is that we can't offer up the notion of paying people or people paying necessarily to have experience, like paying to be part of the studies. And so from a practical point of view, we have to be extraordinarily thoughtful about why we're doing this, how we're doing it, and how we're staying within the legal bounds of the United States where this nonprofit exists currently. Which means that there's not going to be any tradable token of any kind in either phase 0 or phase 1. But this notion that these projects can actually create real sustainable value does fundamentally exist. And so our current hypothesis, and we are just now in phase 0 as we speak, but our fundamental hypothesis is that the time in which some type of reputation token becomes available is as we already have a backdrop of existing research that's been distributed, peer reviewed, already engaged with, and just funded privately. We then move into an open crowdfund ecosystem so that we can actually raise these funds for these projects, for these scientists to be able to engage in this body of work directly. And the core philosophy in this body of work is that everything that we do comes out in the open, whether it's a positive result, a negative result, an indeterminate result. The whole point of this is to attract as many open researchers and citizen-led scientists to engage in this body of work with us as we can, and to globalize it as rapidly as we can. And our internal thesis around this is that in order for this to function and work, we have to come up with some type of model to make that happen. And existing fundraising models simply just don't allow that in a practical way. So we have not figured this out, but we're working on it. And this is fundamentally exploring derivatives between ecosystems like Arbitrum, but also ecosystems like Research Hub, who today have highly restrictive abilities to submit proposals for experiments. What we're planning to do in this body of work is to open that up and to make cognitive physics something that enters people's vocabulary in a big way, because all of us are subject to both of those things. And we're still at the beginning of this work. This is incomplete work that you're bearing witness to here. All right, that's it. That's it. Appreciate you, Jeff.
It's cool to hear you talk about your projects. I've been hearing about it for a while, and it's also very interesting to see, what you also have there is an example of, so many things that I've witnessed in the last 6 years in this industry is there are so many things that are ahead of their time. And DeSci coming out a couple years ago was probably not ready, and there was probably too much focus on assets and the financial part and not enough on the science part. And one thing I know that you guys are doing is that the science is the focus.
Yes.
And that just ties the loop of know your history, know what's happened before you, find the parallels between what you're doing and what's happened before, and try to avoid the same pitfalls of those that came before us. So, we are, first of all, thanks everyone for your patience in me being a little late, and B, really hanging around for a while. This is how to get in touch with us.